G'day expats and welcome to another episode of Expat Chat, episode 76 today. And as always, joined with my co-host, friend, mentor, business partner, and the one that rules the sandpit over there, Brett Evans, who is the Managing Director of the EMEA region for Atlas Wealth Management. How are you going, Brett?
Mate, thanks for that introduction. I'm going to have to walk sideways through doors now with that sort of intro. And usually, people call me things that's not so nice. So, normally they're people who work for the offshore mob who,
Yes.
I don't get Christmas cards from them anymore. So it's quite sad. But thank you very much, everyone, for joining us today. And that gentleman who just delivered an absolute stellar of an effort in the introduction, your name's not Jeremy, James Ridley.
Well,
We had too many J's in our company. So James
we
Ridley,
do.
Managing Director of the APAC region, looks after clients in Asia and America and runs the Australian office. G'day, mate.
G'day, Brett. How's things going in the sandpit today? How's the weather? Any more flooding or crazy flooding?
No, we're still looking good. We're liking it. On the way to work this morning, it's 15, 17 degrees.
Ooh,
Yesterday, it's crispy.
ooh,
It's nice. The days
that's
are
nice.
sitting on the tops of, sort of mid 20s, which is it's
Oh,
like a good crispy Gold Coast winter is the best way to
yeah, that's
describe it. And
fresh.
mate, I'm just
Yeah.
enjoying it. I'm just soaking it up right now. And people are walking around with jumpers on. I'm like, no, no, no. I want to feel goosebumps because in about 4 months' time, I'm going to feel what goosebumps feels like. And so bring it on. Mate, a lot going on in this region. It's just going crazy over here right now. There's so many things going on. Not only just inbound people coming in, rents are going through the roofs, landlords
Mm,
ripping tenants off. What else? We've got big conventions going on. We've got Gulf Food in Dubai. We've got IDEX, which is the military convention going on
mm,
in Abu Dhabi.
hmm.
Uh, Apparently, three-star hotels are charging 3,000 dirhams a night.
Oh
So
gosh.
it gives you an idea of what's going on. The place is full, bursting at the seams.
Yeah, absolutely. I mean, I can't wait to look at those photos when you look at Dubai or UAE and you look at the areas where they just keep expanding. And like there was that photo from like going back in the 90s and you look at it compared to now, it's
Yep.
just ridiculous. It's
So
just ridiculous.
that's
So,
Shakeside Road, which is just there, and then
yep,
the building is the Toyota building, which is just up the road there. So
that's right. Yeah.
yeah, that's all just here
Yep.
where we are.
Yeah. I mean,
So
it's crazy. It's crazy how quickly they just keep expanding, especially from an infrastructure aspect.
mate, turn your back, and there's another building going up, and we joke about it. These little pockets that it's funny how you drive past the building and think, why would you build there? And then you go past 6 months later, and there's now three other buildings around it, and you go past 12 months later, and the area's full. It's like, okay, that's why you built there. It's clearly
That's why,
so.
absolutely.
But
Bit of space.
when you see a road in sand, it's not like Australia where you have like blocks or lots, pegged
Yep.
out and stuff like that. It's just you don't see that.
Yep.
So just it
Yep.
looks random how they just things just get plonked on down. But there's a method to the madness. Someone assures me
Absolutely.
of it. So, but mate, let's
Yep.
not bore the great audience with our platitudes on the Dubai development activity. Let's kick
That's
on
right, mate.
to episode 76, and we're going to talk about superannuation limits today, contribution limits, total balance transfer caps, the whole shebang. You
Absolutely.
did a cracking effort last time with that general advice disclaimer. So, mate, I think you've just did a my job,
Gonna
and I
give
think you should kick it off again.
gonna give me another crack. Okay. Well,
Yeah, yeah.
let me get my voice ready.
Many, many, many.
Ladies, that's it. Ladies and gentlemen and expats, anything you hear today on today's podcast should not be construed as personal, legal, or tax advice. It should be consumed and understood that it's for entertainment purposes only. If you do need advice, please feel free to reach out.
Mate, that's a radio voice, isn't it? And I can hear the lawyers in the background all cheering on, just a perfect delivery with all the right disclaimers in the right spots. Whereas for me, it's just always bass backwards and everything. So,
Ah, well, I mean, a good topic to be talking about today because back in Australia, yeah, there's a lot being talked about right now about superannuation caps and how much you should have in there, and obviously the way that our system is built up. Jim Chalmers thinks it's only benefiting the ultra wealthy, and I mean they talked about capping, and we have caps technically already with our superannuation system, but now they're talking about I think implementing. They're talking about having only 5 million in super, and then they're talking about 3 million, and we've got caps in terms of what we can have in pension mode, or like what's called the sort of the general transfer balance cap. But now they're talking about the total amount you can have in super, both accumulation and
the
account-based pension
TSB,
mode.
isn't it?
That's it. Yep, exactly right. So It's going to be interesting if that gets legislated, but it's definitely up in the air at the moment. But it just seems to be making all the front pages, especially the Australian Financial Review, Anthony Albanese. So it'd be very interesting to see what comes out of the budget in May. What they touch with super. They're always talking about the concessions that we get, the tax concessions within super. Maximum tax rate of 15%, long-term capital gains 10%. You can increase your tax-free component with the right type of contributions, and then in pension mode, it's all tax-free. Getting those franking credits refunded to you. It's can sometimes even just fund a pension, the income stream. So it's going to be very interesting when we come to that budget. But enough talking about it. Let's get into it.
Mate, let's take a step back and just educate people on, super. Number one expat question we always get: can you contribute to super as an expat?
Absolutely. You definitely can. There's nothing really stopping you. I guess Brett and I are probably both thinking the same thing. If you've got a self-managed super fund and you're an expat and you're a non-resident, then you probably shouldn't because you're breaching the active member status. But if you do maintain a standard retail super fund, absolutely, you can, and you probably should, because you probably haven't for a few years now. And that's probably going to be one of your main retirement assets when you're retiring. So definitely give it some attention. Don't forget about it, because you absolutely can contribute depending on where you are in the world.
And how do the contributions work? Because you and I were just chatting off air before about how we're still meeting lots of people who are contributing to super and paying tax, which is the wrong way. So do you want to run us through the difference between a concessional contribution and a non-concessional, and how it compares differently from a resident to a non-resident?
Yeah, so I mean, a concessional contribution, also known as a pre-tax contribution, when that goes into your super fund, contributions tax comes out of that, and it's 15%. That's the rate of tax. We have annual caps that apply to a concessional contribution, which is 27,500, and that's in the current financial year. Just before this call, and I'll keep going and talk more about the other side, but just before this call, Brett and I were talking about how the ordinary time earnings came in and they aren't going to index it. Is that right, Brett?
That's right, mate. So for hot off the press, looking at it right now, we were hoping that those numbers would have pushed up the limits, and it hasn't. So the limits still stand at 27.5 and 110,000 as the non-concessional.
That's right. So not changing for the new financial year. 27,500 is what you can squirrel in. And again, when that goes in, that's pre-tax, taxed at 15% on the way in. Now, for an expat, if they are putting in concessional contributions and they've got no other Australian sourced income back in Australia, then it means you're giving the ATO free money, free tax. So it's important to have an understanding of whether you're doing the right type of contributions when you are contributing to super. And taking that a step further with concessional contributions, there is what's called or known as the catch-up concessional contribution. And right now that allows you to pull up to 4 financial years worth of pre-tax contributions and create a very large tax deduction. And often that gets confused with non-concessional contributions. So you don't want to be giving free money to the ATO for no reason. So when we look at the other side, non-concessional contributions, well, the annual cap, as Brett just said, it's 110,000. It's not changing for the new financial year. And you can also do what's called the bring forward rule, which allows you to contribute up to 330,000. It's an after-tax contribution, increases your tax-free component within your super fund, can be very beneficial for, I suppose, expats, which is somewhat edging towards the end of their working life and need to start thinking pretty hard about retirement planning. Very important. And then I guess looking at the concessional pre-tax contributions, you only want to really use them as part of a tax strategy if you're trying to offset other income, maybe in Australia. But there are some eligibility requirements to do so. And it's also a case with the catch-up. There's also eligibility, I suppose, criteria to be able to use that catch-up concessional contribution as well.
I think also, too, we just give an example of, the jargon can be lost on a lot of folks if they're not dealing with them on a regular period.
That's
so
right.
To explain to everyone, a concessional contribution is what your employer used to pay you when you were a tax resident in Australia. So if you were earning $100,000 a year, you take your 10%, that 10% would go into super, and then the ATO would tax you on the $90,000 left over at your marginal tax rate. Now, obviously, right now, that's why they charge the 15%, contributions tax, because otherwise, if they didn't charge that tax, then everyone would be dumping a heap of money into their super, pre-tax from their income, and the ATO wouldn't get their bounty. Whereas now that we've got an expat, obviously you don't have an employer making contributions on your behalf. So you need to be very, very careful with contributing to super, because I met 2 people this week, I'm only on Thursday, who were making contributions at $27,500, thinking that was the limit and that was the only way they could put money in. And just those quick discovery calls, probably saved. Actually, let me just quickly work it out.
So, I'm going to give you an example as well.
So each of those calls, those little 20-minute calls we have with expats who want to have a chat about what we do, each person I save $4,125.
Yep. Yeah, and I mean it's not a competition, Brett, but I'm going to take you up one more step there.
Yeah, go for it. No, ramp it up.
The call I had yesterday, the gentleman was talking about making use of contribution caps. And I said, that's great. You're thinking the right way, retirement planning. And he was talking about, I'm going to do the catch up. I'm going to do the catch up concessional contribution. I'm going to put 125,000 in, and it's a way that I can get extra money in. And then I might also do an after-tax contribution of about 50,000. I was like, oh, okay. Well, at least you somewhat know the difference. I was like, why are you doing the 125,000 as a catch up? I was like, well, I'll lose the benefit of putting those contributions in because rolling over to another year. I was like, okay, well, are you going to be having any other Australian sourced income at all? Are you going to have any capital gains that you're realizing in Australia whilst you're a non-resident? He said no. I was like, well, if you did do what you're thinking of doing this financial year, you'd be paying $18,750 through your super in tax.
Unnecessarily.
Yep, absolutely. So that one call we had with him yesterday, that saved him 18 grand in tax. So it was a very fruitful call for him, but it was a good sort of call to just run through what his opportunities were in the future.
And then that highlights it. So in 3 days, you and I have had 3 conversations. It's $26,000 in tax people have paid or were going to pay unnecessarily. So, and that's why we wanted to do this call, because we're just seeing it over and over again. People aren't doing things appropriately. That attention to detail is so important. And it's like we always say when we're talking to new people, our clients are smart people. They can do 70% themselves. It's that last 30%, that's why they engage us. We wouldn't be in business if we were charging a fee and clients weren't getting value. And I said 3 people, $26,000 in tax saved, just very quickly like that. So I think we've covered that. Now, let's go on to the next part, which is about the total super balance cap.
Yes.
And the transfer super balance cap and the total super balance. So the TSB and the TSFC, whatever they call it. So I was getting the acronyms mixed up.
There's a few fun acronyms getting around, but
exactly.
In the current financial year we're in right now, be mindful that, there's the general transfer balance cap, there's the total superannuation balance, and all these sort of acronyms and terminology you see, it's what the ATO uses to sort of understand what you've put into super, what you've had in accumulation mode, which if you're working still, you're not drawing down it, that's what you're in right now, and then what you've also put into pension mode. And then if you're drawing a pension, that's good. They have that sort of understanding that balance. And then if you roll that pension back to accumulation mode. So there's this running account where there's debits and credits. And we all do have a lifetime limit of how much we can have in pension mode, because that's that tax-free environment. Every financial year or every 2 financial year, they do index that general transfer balance cap. So in the current financial year we're in right now, it's 1.7 million. So the maximum amount for our lifetime that we can have in pension mode is 1.7 million. However, they are finally going to index it and increase it. So as of 1 July 2023, they're going to index it and move it up to 1.9 million. So effectively allowing you to have 200,000 additional in that pension amount. What is very ordinary about the way that system operates is if you're already in pension mode, it's not a case where you automatically get this additional 200,000 as part of your cap. if you're already in pension mode, unfortunately, the indexation is very different for you as an individual. You only get a small portion of the indexation. I'm not going to go into the actual calculations, but whatever 200,000 is of 1.7 million, quick math, that's pretty much what you apply to what's in your pension mode right now. And that's the small amount that you get to put in extra. So
Extra.
exactly right. So it can really be beneficial to understand that because it could be a case where you're squirreling away an additional 200K into a tax-free environment. But if you're only in pension mode, well, you're only getting a tiny bit. You're only getting pennies on the dollar, essentially, compared to if you weren't in accumulation mode. So won't go into it. But going back, right now, there are a lot of superannuation funds in Australia, whether retail or self-managed super, that have balances well above 1.7 million.
Yep.
And it goes back to when there were no contribution caps, those fun days.
Good old Johnny Howard days when you could plunk $1 million into super in one go.
Oh yeah, people were taking out lines of credit or equity loans on their homes and just going, cool, I'm going to grab that 800K and just throw it into super because I know it's only going to pay tax at 15% and then pay off the debt over the next 20 years or 10 years. So now that there are the contribution caps, and right now, yes, you can have more in super. Once you have your super balance over, say, 1.7 million, it can be quite difficult to put in more after-tax contributions, such as those non-concession amounts. The only ones you can really usually get through without sort of copping any fines or extra taxes on behalf of the ATO, I believe right now it's small business concessions, which don't apply to too many expats because it's regarding assets back in Australia. And then the last one is the downsizer. That's right. Yep. So they don't really apply to normal contribution caps or what your balance is in super. That incentive still exists. But with that indexation, it's important you have an understanding if you're right on the border there and what it means, because it could be the difference of you being able to put an additional 200K into a tax-free environment, which is excellent. But that's,
now let's say,
yeah,
come in.
Well, I mean, I was just going to say that that's a general sort of summary of this transfer balance cap. But again, in pension mode, the max we can now have is up to that 1.7, but it's changing to 1.9, which is really attractive. And then with what they're talking about in the media right now, well, they're thinking about capping out at, say, 3 million in total of what you can have in super. So I'm not sure how that's going to apply to all these other super funds, which have got a large amount, more than 3 million. I mean, how do they carve it out for them? But that's a high-level understanding of just the pension cap, the transfer balance cap system.
So let's run through a case study of a client's got 2.5 million in super.
Mm-hmm.
And we should also point out, this is not per couple, this is per person. So these caps are individual. So you can double it if husband and wife work together as a team. So let's say, for example, Fred in Dubai has a $2.5 million super fund. He hangs up the boots. He goes, you know what? I'm done. Halas, no more. I'm not working. I'm going in retirement.
Mm-hmm.
Pre or post 30 June, doesn't matter. You pick the time frame. How does he transfer, and what happens to the remaining amount? That sort of happens in the background. If you've got 2.5 and currently the cap is 1.7, so it moves 1.7 across, what happens to the remaining amount?
Well, that stays in accumulation mode. So it's still taxed at the ordinary 15%. That's obviously just the short-term investment earnings. He can still take a benefit payment from that. And depending on his age, generally that should be still tax-free. But because they've introduced this cap, it means they can have a maximum amount of 1.7 in the tax-free environment, be drawing out a tax-free income stream. But the ATO and the government still get to tax you on the remainder portion, which is the difference, the delta between 2.5 to 1.7. They're still getting obviously 15% tax on your investment earnings. If you're realizing capital gains after 12 months, they're getting 10%. You still get the benefit of maybe franking credits in the accumulation account and those sort of things. If that individual commences at 1.7 and then rolls back, let's say they pull out 100K out of the 1.7, out of the pension mode, and they roll back 1.6, that 1.6 is now a sort of a debit on their account. So technically, because they've taken 1.7, they're down to 1.6, they've rolled it back, they still have the opportunity to put 1.6 back into pension mode. They're not locked out of that. And that's what also causes a lot of confusion when there's this concept of pension refresh strategies. You're rolling it back, you're rolling it forward, you're rolling it back, you're rolling it forward. If you're not keeping an eye on it, you can actually blow through the lifetime cap accidentally. And then because you're blowing through it, well, it also means that you will only now be able to have your sort of pension in sort of that taxation phase mode where, or accumulation mode, I should say, where it's still being taxed at 15%, even though it's a tax-free income. So it's very important to keep in mind or be mindful of that.
Yep, no, that's good. I mean, I think that's an important point because that's something that causes a lot of confusion. People saying, well, if I've got 2.5 and I can only move 1.7, do I lose the remaining amount? And, like I explained to a client on Monday, and we'll dovetail in a case study here at the same time, so provide a bit more pertinence. I said, just because you've got a remaining balance sitting in accumulation phase, especially on the income side, doesn't mean you necessarily have to cop the 15% tax up, because you can use things like franking credits and those sort of things to extinguish, that liability, as well as get the refund back on the unused portion, which can then wait out the unfranked dividends as well too. And he said when we rule the numbers off on 30 June, he wants to see how close we can get to having a zero tax liability in accumulation phase. So me being me, challenge accepted. I said, let's go for it.
Yeah. I mean, if a large portion of his income is franked dividends, you're not going to have an issue at all. It's when you have a diversified portfolio and you have exposure to international income streams. Well, as we know, there's not many tax credits there, so it can wash out. But at least 30 or 40% franked, I think you're pretty much covered there.
Yeah, and because the international side of it doesn't provide high yields, so the high yielding portion is the Australian side, which is the franking side, and then the non-franked side is the international side, where you're only getting 1%. So even though you're going to be holding 50% of your portfolio internationally, getting a 1% yield, and then 50% of your portfolio is Australian, you're getting a 4% yield, guess what? It's going to weigh out pretty well.
That's right. And I reckon Australian equities will probably outperform global equities this year. We're off to a strong start, that's for sure. Or I think every share market's off to a strong start. But everyone's got to remember we have some very juicy dividend yields on top of that capital growth.
Juicy dividend yields and a less reliance on tech. I think that's what's causing most issues overseas right now. And even though, as we discussed, people being sacked in tech, but they're also being rehired almost straight away. So there's not really much of a concern there. But certainly the share prices are reflecting that change of attitude amongst investors. And people don't realize that you invest in the S&P 500, the top 6 companies out of the 10 are tech. So you're not just investing in the NASDAQ, you're investing in tech as well in the S&P 500. So,
well, I mean, that's why you saw the big drawdown impact last year with those kind of indexes that are dominated by tech. And I was looking at an interesting, really interesting graph on, I know we're sidestepping here. Sorry, ladies and gentlemen.
We always do.
Interesting graph. When you look at a lot of the tech companies, what they were hiring through COVID, 2020, late 2020 and 2021, should look at the graph on Amazon. Like, its hiring scale was just ridiculous. That thousands of employees that it hired around the world. And then it starts to compare it to sort of the layoffs that are happening. Amazon has one of the biggest layoffs to date since the start of the year. But in terms of its sort of net turnover, it also hired the most people in the last 3 years as well. And this is compared to Google or Alphabet, those sort of ones. So it's really interesting that it's copying a lot of slack, but it's also gave out probably the most jobs through that period as well.
Yeah, and that's the thing. I think it's these companies ramp up, ramp down very quickly. And because of their processes, they can pretty much take on a lot of unskilled people in that regard and skill them up. And then you put them through the Amazon factory and then off they go.
Yep, absolutely. Absolutely.
Right, mate. Well, I think we leave it there. I think that's a good cover on super limits and contribution limits and how it works. So that was question number 2 that people responded to on our Australian Expat Financial Forum group. So for those on the call, we don't understand what we're going through. We do have a Facebook group with over 1,200 or 1,300 members. We put up a post early this month saying, righto, guys, what are the key topics you want us to talk about? Number 1, update on the tax residency. We did that last week. And if you go back to the previous episode, you'll see that one. Today, obviously, we're covering off on the super limits. So here we go. As promised, next week, we'll be talking about inheritance. So we'll cover off on that one there as well, K3 events and all that sort of juicy stuff. So, mate, let's leave it there for the fine folks out there to get on with other chores for the day, and we'll talk to you next week.
Sounds good, Brett. See you
Right.
next time.
Take care. Thanks, mate.